Welcome to the deep dive. Today we're doing something incredibly critical. We're going to analyze what is, well, without a doubt, the single most valuable asset any of us have.
And that's our ability to actually earn an income.
Exactly. It's the engine that fuels, every single part of your life, your daily expenses, your retirement goals, everything. And it's shocking how often it's the most overlooked part of a financial plan.
It's a huge mistake waiting to happen. We've been digging through a mountain of sources, complex tax laws, Canadian court cases on insurance, really detailed financial plans, all of it focused on one thing.
Income protection, specifically through disability insurance or DI.
Right. And our mission here is to sort of translate all that technical jargon, all that legalese into something you can actually use.
Clear, actionable ideas. We want you to understand the rules so you can steer clear of these massive tax and legal traps that honestly dismantle people's financial security all the time.
And for this, we're framing our whole discussion in the context of Muneris Financial Services. They're a Vancouver-based firm, been around since 1995, and they really specialize in tying together investment management, retirement planning, and crucially, tax strategy.
And the importance here, it can't be overstated. If that income engine of yours just stops,
Even for a few months.
the whole thing falls apart.
Yeah.
Your investments, your house, the kids' education fund, it all comes crashing down at that primary cash flow. Just disappears.
It's the absolute foundation. You wouldn't buy a brand new car and not get insurance on it, right?
Of course not.
Yet, so many people don't insure the very income stream that bought the car, the house, and everything else in the first place. It's the ultimate piece of financial risk management.
Okay, so let's start by looking at the bigger picture that firms like Muneris operate in. I think understanding their full scope of services really shows why something as complex as DI needs a holistic approach.
Definitely. Muneris has been in Vancouver since 1995, and they've built their reputation on integrating everything: investments, retirement, taxes. Their whole philosophy is about giving people the tools to make truly informed decisions.
So they're not just selling a product here and there. They're building a whole financial plan that covers your entire life, really.
Yeah.
From saving and investing all the way to estate planning.
And risk management isn't some add-on. For them, it's a central pillar of that plan. It has to be.
That integration seems to be the key.
It is. Look at their investment offerings. They've got everything you'd expect for a Canadian saver: RRSPs, RESPs, RIFs, TFSAs, even the new FHSA.
Right.
And the products range from annuities and GICs to mutual funds and segregated funds, plus group investments for businesses. They see the whole board, so when they recommend a protection product, they know exactly how it fits with your tax situation and your retirement goals.
Okay, so let's zoom in on their insurance and protection offerings. This is really the context for our deep dive today.
Their portfolio is pretty comprehensive. You've got life insurance term, permanent, universal, you name it, plus things like health, dental, long-term care, and critical illness. And they have a big focus on business owners, too.
And this is where it gets really sophisticated, right? Especially for, say, a high-earning professional. They mention group benefits, but also things like a health and welfare trust or FlexSave. Why is that specific offering so important?
The HWT, or FlexSave, is a game changer. It's not just another group plan, it's a tax strategy.
How so?
Well, instead of a rigid traditional group plan, a health and welfare trust lets a business owner fund healthcare and dental costs for employees, and often themselves, on a completely tax-free basis.
So it's more flexible and way more tax efficient than a one-size-fits-all plan.
Exactly. It can turn what would have been a personal after-tax medical expense into a legitimate deductible business expense. It shows they're thinking about tax optimization from every angle, which is the exact mindset you need for structuring disability insurance properly.
And their planning goes right to the end with estate planning, guiding clients on wills and highlighting the absolute chaos that happens when a family is left without one.
When you put all that together, the investments, the risk management, the tax strategy, you see why just getting generic advice on income protection is never enough.
Yeah, that makes perfect sense. And look, I think if you're listening to this and realizing you have some gaps in your own plan, this is probably a good time to mention who to talk to.
Absolutely. Our sources provide direct contact info.
Right. You can reach Mansoor Khalili at Muneris Financial Services. His phone number for call or text is 778-898-3202.
His email is mansoor@muneris.com.
And the website is just Muneris.com. They're based in North Vancouver, but they help clients all across Canada.
Okay, so let's get into the nitty-gritty of DI itself.
Let's do it. Its core job, as we said, is just pure income replacement. When you're sick or hurt and can't work, How much of your income are we talking about typically?
Usually you're looking at replacing somewhere between 60% and 85% of your regular salary.
And there's a reason it's not 100%.
Yeah, the industry does that on purpose. The benefit needs to be enough to live on to pay your mortgage, but they never want it to be so comfortable that there's no financial reason to, you know, try to get back to work if you can.
Makes sense. Okay, let's tackle the first big misunderstanding. That word, permanent. When a policy says it covers a permanent disability, what does that actually mean?
This is probably the biggest misconception out there. It leads to so much confusion down the road. Permanent describes the nature of your condition,
Not the payments,
not the payments at all. It just means your illness or injury is severe, it's long-lasting, it's unlikely to just go away, it has a permanent character.
but the money can definitely stop.
Oh, absolutely. The vast majority of these policies stop paying at age 65.
Yeah.
So if you get disabled at 40, they'll pay for 25 years, but only if you continue to meet their definition of disabled.
And they are checking up on you.
Constantly. They have case managers whose entire job is to reassess your medical files. If you recover enough to go back to work at age 55, the payments stop at 55.
Okay, that's a huge clarification. So where do people even get this kind of protection? I think we can break it down into, what, 4 main buckets?
4 buckets, yeah. The first, and the one that gives you the most control, is an individual plan. This is one you buy yourself through a broker.
So you can customize it, pick your features, and it's yours to keep.
Exactly. It's portable. If you change jobs, the policy comes with you. That's a massive advantage.
Bucket number 2 is the most common one, group plans.
Right. The one you get through your job or your union. They're cheaper. Sometimes your employer even pays for it, and you usually don't have to do a medical exam.
But the big catch.
The catch is it's tied to your job. You leave that job, you lose that coverage. That lack of portability can be a real killer.
Then you have bucket 3, which is more niche, special purpose plans.
Yeah, think of the mortgage insurance the bank tries to sell you, or the benefits you might get from your car insurance after an accident. Very specific, very narrow.
And the last bucket is the foundation for everyone, government plans.
The safety net. So that's your Canada Pension Plan Disability, or CPPD, for long-term issues. For short-term stuff, there's EI sickness benefits. And then there's workers' comp.
But workers' comp is a big one to understand. It only covers you if you get hurt at work or because of your work, right?
Precisely. It won't do a thing for you if you have a heart attack while you're at home on a Saturday.
Let's go back to the group versus individual plans, especially for people earning a high income. You hear about this cap problem all the time.
This is a classic trap. Group plans are built for the average salary, so they put a ceiling on the monthly benefit. Let's say your group plan says it replaces 60% of your income, but the fine print says the maximum payout is, say, $6,000 a month.
Okay, so that's $72,000 a year.
Right. But what if you're a professional making $250,000 a year? That $72,000 is only replacing about 28% of your income, not the 60% you thought you were getting.
Wow, so your standard of living would just plummet.
Completely. That's why for any high earner, an individual top-up plan isn't a luxury. It's an absolute necessity to actually get the income replacement ratio your financial plan depends on.
All right, now let's get to what might be the single most important part of this whole conversation, the massive tax trap. It all comes down to one tiny detail. Who pays the premium?
This is the million-dollar lesson right here. The rule is so simple it's scary. If you, the individual, pay 100% of the premium with your own after-tax money,
Then the benefit is completely tax-free.
completely tax-free. A $5,000 a month benefit means $5,000 in your bank account. The CRA doesn't touch a penny of it.
And the trap.
The trap is if your employer pays any part of that premium, even just 1%, and they don't include that payment as a taxable benefit on your T4 slip.
Then the whole benefit becomes taxable income.
The entire thing becomes fully taxable income.
Let's just put some numbers on that. That same $5,000 a month or $60,000 a year. If that's taxable, you could be losing, what, $1,500, maybe $2,000 of it every single month to taxes.
Over a 10-year claim, that's a couple $100,000 gone. Over 20 years, it's approaching $500,000. It is a devastating financial hit, all because of a small choice made years earlier about who writes the premium check.
So if I'm in a group plan where my employer pays, how do I get around this? I know our sources mention a CRA rule, IT 428.
This is where you need good advice. The CRA gives you 2 ways to fix this. The cleanest way is to have your employer deduct the full premium cost right from your gross pay.
So even though the company's handling it, The CRA sees it as your money paying the bill.
Exactly. And because it's your money, the future benefit is tax-free.
Okay, what's the other strategy? The one that's like a strategic trade-off.
This is the smart play for high earners. If your employer insists on paying the premium, let's say it costs them $2,000 a year to cover you, they just have to add that $2,000 to your T4 slip as a taxable benefit.
Do I pay tax on that $2,000 today? Maybe an extra, what, $700 in taxes here?
Right. You pay a small, known tax bill on the premium today to guarantee that the huge potential benefit, that $60,000 a year, is entirely tax-free tomorrow when you desperately need it. It's a no-brainer.
What about the self-employed? How do these rules work for a sole proprietor?
For a sole proprietor, it's pretty clear-cut. The downside is they cannot deduct the premiums for their personal DI policy as a business expense.
But the upside must be huge.
The upside is massive. Because they paid for it with after-tax dollars, the benefit is always tax-free, no questions asked.
And they protect their business costs, like rent and utilities, with a different product entirely.
Exactly. That's called business overhead expense, or BOE insurance. The premiums for BOE are tax-deductible. But the benefits you receive from it are taxable income because that income is designed to just wash out against your ongoing deductible business expenses.
Okay, so you have the right policy, it's structured for tax efficiency, and then the worst happens. You actually need to use it. What is the very first step?
Notification. You have to immediately tell your HR department or your union rep. They're the gatekeepers. They'll give you the claim forms you need to get the ball rolling.
And once those forms are in, what's happening at the insurance company?
They'll acknowledge the claim, usually within 5 days, and your file gets assigned to someone called an Abilities Case Manager, or ACM.
And this ACM is basically the decision maker. What are they looking at?
It's more than just a doctor's note. They look at all the medical reports, sure, but they also dig into your day-to-day abilities, the specific demands of your job, and how your condition stops you from doing that specific job.
Insurers often promise a quick decision, maybe 10 business days. But there's a huge catch to that promise, isn't there?
A massive catch. It's 10 business days from when they receive all necessary information. And this is where the delays always happen.
And whose job is it to get all that information?
It is 100% your responsibility. The applicants. You have to chase your family doctor, your specialist, get all the reports sent in, and you have to pay for it too. Doctors charge fees to fill out those long forms.
So if your doctor is slow or the forms are incomplete, the whole thing just stalls.
Precisely. It's the #1 reason claims get delayed or even denied. The insurer just says, well, we don't have enough information to approve it. You have to be incredibly proactive.
Okay, let's talk about the elimination period, or the waiting period, the time you have to wait before the benefits start.
This is the time you're self-insuring. And there's a big coordination trap here. The benefits start after your elimination period is over or when your paid sick leave runs out, whichever is later.
So if my policy has a 90-day waiting period, but my company gives me 20 weeks of sick pay,
the insurance company doesn't pay you a dime until week 21. They wait for every other source of income to be completely exhausted first.
so you really need to plan your emergency fund around that.
You have to. And this is why choosing a longer elimination period, say 180 days instead of 30, is a big risk. Yes, it makes your premium much cheaper.
But you're on the hook for 6 months of no income.
You are self-insuring for half a year. If you don't have a very healthy emergency fund ready to go, that cheap premium is a terrible decision. You could end up in a financial catastrophe while you're waiting for the first check.
Now let's get into the legal definitions in the contract. These policies have 2 different phases, 2 different definitions of disability.
They do. Phase 1 is the most generous. It's usually for the first 24 months, and it's called the own occupation definition.
Meaning you're considered disabled if you can't do the main duties of your own specific job.
That's it. So a surgeon who develops a hand tremor can't perform surgery. Under the own occupation rule, they're disabled, even if they could easily go teach at a university or do something else.
But at that 2-year mark, everything changes. The definition switches to the much tougher any occupation standard.
And that's the big legal hurdle. The contract now says you have to be disabled from any occupation you're reasonably suited for by education, training, or experience.
Which sounds like a get-out-of-jail-free card for the insurance company. They could just say, well, you can be a greeter at Walmart.
That's how they'd love to interpret it. But this is where the Canadian courts have really stepped in to protect people. They say a literal reading of that clause is, frankly, unconscionable.
So they apply something called a liberal construction.
Yes, and another legal idea called contra proferentum. It's a Latin term.
Okay, what does that mean in plain English?
It means against the one who offers. Since the insurance company wrote the entire contract and you just signed it, any confusing or ambiguous language in that contract is interpreted in the way that favors you, not them.
The tie goes to the policyholder.
Every time. And beyond that, judges use what's called a holistic subjective test. They don't just look at a list of jobs.
They look at the whole person.
Your whole life. Your age. It's harder for a 60-year-old to retrain. Your experience. And this is the most important part. They consider your social standing and the dignity of work.
So they can't force a former CEO to take a minimum wage job. The new job has to be, what's the word? Commensurate.
Commensurate work. That's the legal standard. An insurer cannot cut off your benefits unless they can prove you're capable of doing a job that is comparable in pay, in status, and in nature to the one you lost. That legal shield is what stops the any occupation clause from being a death sentence for your claim.
What about trying to go back to work? You feel a bit better, you give it a shot for a few weeks, but it doesn't work out. I've heard insurers use that to terminate benefits.
They try to, all the time. An adjuster sees you work for 2 weeks and says, see, you're not disabled anymore.
But the courts protect you there too.
They do. The law recognizes that recovery isn't a straight line. It involves trial and error. As long as your doctor supported your attempt to return to work, a short, unsuccessful try shouldn't be used against you. Benefits should be reinstated.
Okay, let's talk about coordination with government benefits, specifically the CPPD offset. Why do all private insurance plans force you to apply for the Canada Pension Plan disability benefit?
It's all about money. CPPD is seen as the first payer. The private insurer makes you apply so that if you get approved, they can reduce what they pay you dollar for dollar by whatever you get from the government.
It saves them money, but it creates a horrible tax problem for the claimant, this retroactive payment tax trap.
It's a financial nightmare. CPPD can take a year, sometimes more, to approve a claim. All that time, your private insurer is paying your full benefit.
Then CPPD gets approved, and they send a big lump sum of back pay. But it doesn't go to you.
No, it goes straight to the insurance company to pay them back. You never even see the money.
But the CRA sees it differently.
The CRA says that lump sum is your taxable income for the year it was paid, even though you never received it. So suddenly you get a T4A slip in the mail for, say, $20,000 or $30,000, and you're hit with a massive, unexpected tax bill. You have to plan for that.
Given all these risks, let's talk about building the strongest possible individual policy. What are the non-negotiable riders or add-ons that you need? Let's start with the cost of living adjustment, or PLA.
PLA is absolutely essential. If you become disabled in your 30s, you could be on a claim for decades. Without PLA, inflation will just eat your benefit alive. A $5,000 monthly benefit today will feel like half that in 20 years.
So the CLA rider automatically increases your benefit each year to keep up with inflation.
Right. And the other one, which is pure gold for young professionals, is the Future Increase Option, or FIO.
Why is that one so critical?
It guarantees you the right to buy more coverage in the future as your income goes up, with no new medical questions asked.
So let's say I get a policy when I'm 25. Then at 40, my income has tripled, but now I have some health issue that makes me uninsurable.
Without FIO, you're stuck with the small amount of coverage you bought when you were 25. With FIO, you just exercise your option, buy the extra coverage you need to match your new salary, and they can't say no. It protects your future insurability.
Are there any other important ones to consider?
The residual disability rider is a big one. It pays a partial benefit if you can go back to work part-time but are earning less because of your disability. And some people like the return of premium rider. If you never make a claim, you can get some of your premiums back. It's like a forced savings plan.
This has been an incredibly detailed dive. It shows just how complex and full of traps this whole area is. Let's try to boil it down to the 3 most important takeaways for our listener.
Number 1 has to be the tax rule. Pay the premium yourself with after-tax money to get a tax-free benefit. It is a night and day difference financially. Make sure your plan is set up that way.
Number 2, the law is on your side. Don't be terrified by that any occupation clause. The courts have built a powerful shield with the commensurate job test. Your benefits can't be cut unless there's a truly comparable job you can do.
And number 3, if you're buying your own policy, the future increase option and the cost of living adjustment riders are not optional. They are non-negotiable. They protect you from future uninsurability and from inflation.
I think it's clear from all this that professional advice isn't just a nice to have, it's mandatory. You need an advisor who gets these rules. And if you have a group plan, you have to ask for the full benefit booklet, the actual legal contract, not just the summary from HR.
And don't forget, there are safety nets. Assurance protects you if your insurance company fails up to a certain limit. And the Ombud Service for Life and Health Insurance, OLHI, can help you with disputes for free.
And because these decisions are so critical for your financial survival, we should repeat that contact information one more time. For personalized advice on protecting your income, you can reach Mansoor Khalili at Muneris Financial Services.
You can call or text him at 778-898-3202.
Email is mansoor@muneris.com, and the website, again, is muneris.com.
Which brings us to our final thought for you. Business owners and high net worth individuals spend a fortune on insurance to protect their companies, key person insurance, buy-sell agreements, all of it. They do it to protect their business assets and their legacy.
So the question we want to leave you with is this. Are you applying that same level of strategic, sophisticated protection to your own single most important asset, your ability to earn an income? How much is your future worth to you today?